Retirement is often seen as a destination, but we believe it's an opportunity to pursue your passions, realize your dreams, and live a purposeful life. Great decisions, incredible lives. Retire with Intention podcast is about more than just money. It's about embracing the things that truly matter, the experiences, the relationships, and the impact you leave behind. Here is your host, John Creekmur.
Well, everybody, welcome back to the Great Decisions, Incredible Lives, Retire with Intention podcast. I want to tell you, today I am so pumped. I have David Roosevelt with us and from Dallas, Texas, and it's just been a tremendous joy to be able to meet him and to be able to kind of walk through some common backgrounds and even some really favorite vacation spots for families. Maybe we'll hop into some of that today. We'll see how things go. But, David is just a phenomenal resource, a phenomenal thinker as far as on credit markets, as far as interest rates, where things are really kind of navigating from and where we're sitting at now, and just probably the proper way to think through things. And as you all know, we really kind of walk through some core principles on how we can kind of live that incredible life, which that incredible life is your definition of an incredible life. And the first one is that you know your core values. And number two is that you set goals based upon your core values. But at the end of it all, number four is to be open to wise counsel. And I want to encourage you today as you kind of walk through what we're going to talk about today is to recognize that it's to be open to wise counsel. And oftentimes we look at social media and we see things that are on different platforms we're looking at. Maybe we do a Google search online or we look at the news media and we have a lot of counsel, but really is it informed? Is it educated? Is it wise? Not quite certain. And as you're a listener and follower of Creekmur Wealth over the years, you know that we really strive to introduce you to people that can help you make good decisions. And I know with David today, that's going to be a key point as far as the things that we're walking through. It's a little background of David as far as his background and as far as the things of interest to him, a little glimpse into who he is. And so if David, he is the founder of Roosevelt. Well, David, I just kind of blipped out here. Is it Roosevelt? There it is.
Roosevelt Capital Management.
There we go. So founder of Roosevelt Capital Management. Apologize for that.
That's a problem.
Directly responsible for investing, risk management, and trading. His entire career has been in the investment management business. And so Roosevelt Investments, a family office. Morgan Stanley is a credit portfolio manager, risk manager, and trader over at Jacobson Partners as a private equity. And then also at BlackRock as a fixed income account manager. MBA as an Austin Scholar with honors from Kellogg Graduate School of Management at Northwestern University, a bachelor's cum laude from Harvard University, and so a huge background, phenomenal mind when it comes to the markets, and I'm really excited to have David with us today. And David, how long did you found Roosevelt?
Yeah, so Roosevelt was founded about 5 years ago, although we've been doing this for a lot longer, and we have a 13-year track record in the fixed income space.
You know, you say track record, and I saw a little thing on your website. Was it GIPS? Is that what it was?
So are you familiar with the term GIPS Compliant?
Yeah. Well, could you explain that to everybody, what that means, and why is that a big deal?
Yeah, so the CFA Institute has a standard, and that for calculating returns for different types of managers. So a GIPS compliant manager means that you have met that standard. And in our case, we have met that standard, and we've been verified by a firm called ACA Compliance. Mm-hmm. The reason that standard is so incredibly important is when you start calculating returns, there are a lot of different ways that they can be calculated. And as an investor or as somebody who's seeking investment advice, it's always good to know, as the person who's giving you advice, do they have a track record? And is that track record calculated correctly? So that's why we went out and got the GIPS standard, GIPS compliant standard for our firm.
And David, you know, I really, that makes so much sense. And I've looked at GIPS in the past as far as the calculation, as far as the way it's walked through and verified. And I remember a story, it's probably goodness, 7-8 years ago, and we had someone come into our office talking about the rate of return they were receiving from their current advisor. And the numbers were just astonishing. I was like, wow, how in the world is that happening? Well, the devil's in the details because the calculation was so incorrect, and they were actually inputting ongoing deposits as actually growth in the account, their calculation, which that's a simple error, but it really put a person where they were really underperforming their risk-based measurement indice by a large portion, but they thought they were outperforming, and it affected their decisions as far as on being in a good spot. So I think it's critical for all the listeners to understand. That means that David today is going to be speaking from a position of making sure everything that's communicated is technically accurate. That is really kind of who he is as an individual, and it's a big part of making sure you're working with someone that is ours on the GIPS standard. And so moving through things, I mean, you've worked at some pretty prestigious institutions like Morgan Stanley and BlackRock, and tremendous educational background also. But what insights and skills did you bring from those experiences whenever you founded Roosevelt Capital?
Yeah, boy, it's such a great question. Each one of these organizations has taught me different things, and fixed income is pretty esoteric, and the concepts in it are really pretty challenging. So, John, it's amazing. Like when I was at Morgan Stanley, I was like, oh, that's what the vice president I was working for at BlackRock was trying to teach me. Now I finally got it. These concepts of duration, yield to worst, yield to call, default risk, reinvestment risk, these are not sayings that the average person is thinking about day in and day out. So, I started my career at BlackRock in 1993 after I graduated from college. And it is fair to say, I was just trying to figure out which way was up, because, business, accounting, finance, it's a different language. And each area of business, each specialty of business is its own language. So when I started at BlackRock in 1993, it was really just about forming the pieces of the puzzle of the language. Those things that I just mentioned to you. What's a corporate bond? What's a treasury bond? What's a muni bond? What's an asset-backed security? What's the different characteristics of each? What are the variables that we use to measure those characteristics? So BlackRock was really just trying to form the pieces of the puzzle to understand things better. Jacobson Partners, which was a private equity firm that I worked for also in New York after BlackRock, that really taught me financial modeling, and it taught me about bank covenants, forecasting, credit analysis, things that some of us are very familiar with these terms, like debt to EBITDA, interest coverage ratio. So that was kind of BlackRock. Business school, I still have two professors in business school who were very, very important to my learning. Robert McDonald from Northwestern and Scott McEwen, and taught a class called decision analysis. It created decision trees and how to think probabilistically. That's so critical in business and in the fixed income space. Robert McDonald taught me all about derivatives. And then I went to Morgan Stanley, and I started trading credit default swaps. Single name credit default swaps, and some of your listeners may be familiar with something called, and what is a credit default swap? Credit default swap is effectively a derivative, and it's insurance on bonds.
Okay.
And there's something called CDX, which is an index that a lot of people focus on in the credit space for corporate bonds, which measures the spread between U.S. Treasuries and corporate bonds. And it's effectively a basket of a whole bunch of individual credit default swaps. So I learned a lot about, probability as it applies to credit at trading default swaps. Then I moved over to the loan desk, and more little known fact, all the firms on Wall Street, they all have to own loans. People are like, well, why would a Morgan Stanley, a Goldman Sachs, own loans? And it's true of JP Morgan and Citibank and Chase. Well, somebody like a PepsiCo, they're not going to give Morgan Stanley or Goldman Sachs or Barclays that plum M&A assignment, right, unless Morgan Stanley's in the syndicate that's lending them money. So Morgan Stanley, when I was there, had a book of loans, $60 billion long notional portfolio, and it was a mark-to-market book. So we had $30 billion of shorts against it in order to hedge the mark-to-market risk as well as as the idiosyncratic risk. So that desk was fantastic because I really got to learn about everything in the credit space and in the interest rate space, interest rate swaps, how to fund these loans. I launched a CLO, Stanford Collateralized Loan Obligation, as a funding source, using our loans as collateral to help Morgan Stanley get cheaper funding. Correlation products, which is just tranching default risk on these things. Options on credit default swaps. So tremendous exposure to the whole area of interest rate risk and credit risk at Morgan Stanley, as well as international exposure. Our desk managed not only the North American risk, but also the European risk and the Asian risk for Morgan Stanley. So, and I'm going to digress here, if it's okay, and tell you a little bit about my family, because it was October of 2008, and I was with my wife and my two younger daughters, 6 and 5 at the time, and I looked over at my wife and I said, honey, I'm not sure Morgan Stanley is going to exist as a solvent entity. She looks at me and she goes, I understood a lot of the risks of being a Wall Street trader's wife, but having Morgan Stanley go bankrupt was not one of them.
Yeah.
And then she said, are we building our lives on sand? We lived outside of the city at that point in a little community called Larchmont. I was on a 5:29 a.m. train in the morning, got home around 7:30 at night. So it's fair to say that those things by themselves made my wife kind of feel like a single mom.
Wow, sure.
So I looked at her and I said, you know what, you're right. Hopefully Morgan Stanley doesn't file. We were pretty close in October of 2008. They didn't file, and March of 2009, after I got my bonus, we resigned and we moved back to Dallas.
Wow.
My family has a family office here. We're a family that has been in the oil and gas business for many, many decades. So I came back here to manage my family's liquidity bucket, if you will. And as a part of managing that liquidity bucket, I had other families start coming to our family and saying, hey, we really like what you guys are doing in terms of managing your family's liquidity. Would you manage our liquidity the way you're managing your families? And the answer was, unfortunately, we can't, because we, as a family office, we operate under the family office exclusion. And so I ended up eventually forming a registered investment advisor, separate and distinct from the family, so that we could start managing some of those folks' capital. And so we've been, as Roosevelt Capital Management, managing third-party capital for approaching 4 years now. And so we've been having a lot of fun doing that. And we started, obviously, in the fixed income space, because that's what I was doing on behalf of the family.
Yeah, an incredible story. When you think about it, that 2008, 2010 time period, that was sort of transformative in so many people's lives, as it was with you and your family, and recognizing, boy, what a wise question by your wife. You know, are we building our lives on sand? I mean, that's an incredible thought. And yet, just by taking that and processing that, is kind of like, man, that changed the direction of your life. And when I think about it, in that time period, there was just a lot of complexity in the financial markets, and we still have complexity today. And there was a lot of instability happening in the financial markets caused by a lot of different factors.
Right.
And we look at where we're sitting at today. And so today we're sitting in a period of time post-COVID in which all the governments of the world, they pulled so many levers and pulleys in that period of time. And I always believe truth at time is the greatest indicator of where things are at. Is that a good decision, bad decision? We find out in time. Reality is, though, it created instability in the financial markets. And even where we sit right now, we're seeing a lot of things that happened even in 2022 with the Lehman Brothers bond index was down 16% thereabouts last year. And so a lot of folks looked at their cash management and they looked at their short-term risk management and they saw negative numbers there. Can you walk us through a little bit, David, in this recent period of time? And there's some similarities and some differences to past times of instability. Can you walk us through kind of where we're at as far as interest rate cycle, where we're at as far as risk, and even some things that we've already experienced this year? Banks going into default as far as a manage of their credit risk. U.S. government received their Fitch rating, actually got decreased. We have a number, I think that's the last number I saw, Fitch said they might be decreasing ratings on 13 different banks, and it came out today. Can you walk us through kind of where we're at on interest rates, and from a risk standpoint, how would a manager view where we're at right now in managing risk?
Yeah, such great questions. So let's take a little step back and just talk about what are the major risks that one needs to think about when they're allocating capital into the fixed income markets or cash markets. First and foremost, and you've alluded to two of them, interest rate risk, right? What is interest rate risk? Because people got hammered, and I think a lot of those people don't necessarily understand why.
Yeah, good point.
So, yeah, and then there's default risk. In the area of default risk, you bring up kind of Silicon Valley Bank and the whole regional banking crisis and just default risk in general. There are also kind of, I'd say, two other major risks in the fixed income space. And one is what I call complexity risk. And we see those in types of structures like CLOs, which are kind of one of the suit du jour today. And the last risk is what I would call liquidity risk. Can you get your money when you need it? So let's talk specifically about interest rate risk for a second. So interest rates, when people talk about interest rates, they talk about the interest rate, they talk about it as if it's one thing. It's actually many different things. There's something called the yield curve, and that yield curve is a collection of all those interest rates. So the Fed funds rate is effectively an overnight rate, and it's kind of the rate that everybody's talking about most of the time. And as a result of the pandemic, Fed fund rate was effectively zero because of what you have alluded to, which is massive inflation that was a function of central bank stimulus, not only here in the United States, but globally, combined with significant supply chain disruption. You had significant inflation. Well, what is the Fed's role? The Fed's role is to fight that inflation, because inflation, we can talk about this later if you'd like, but it can be very damaging to an economy over the long term. Okay, so, and let me actually, can I share my screen? Do you mind if I? Yeah, so let me share my screen with you, because there's the old adage that a picture is worth 1,000 words. Let's just go take a look at the 5-year treasury, right? So if we go look at the John, what we're looking at here is Bloomberg. This is a screen from a Bloomberg terminal. And let's just go look at the 5-year treasury over the last 5 years. So right down here, this is kind of February of 2000, which is right at the time of the pandemic. The 5-year treasury was 30 basis points, right? So today it's at 4.33%. This rise in interest rate is really unprecedented. And if we look back, and if we looked at this through the lens of the 10-year treasury, we can look at it through the 1-year treasury, 5-year treasury, 10-year treasury, 30-year treasury. It's all going to show the same story. Interest rates were incredibly low pre-pandemic, post-pandemic, and then because of the inflation that the pandemic created, interest rates went up significantly. Now, let's talk about what that does to a portfolio. There's this concept in fixed income called duration. Let's assume you're investing in a bond, John, let's use the most extreme bond possible, with the 30-year treasury, right? Has no default risk. In theory, the safest security in the world, or U.S. treasuries are the safest securities in the world. What buyers of that security didn't appreciate is that even though it might be the safest security in the world from a default risk perspective, anytime you take on interest rate risk, and you take on interest rate risk, the further out the bond you buy matures. So there's this concept called duration. I'm not going to get into the math behind it unless you want to. We can do that later. But in essence, all it says is if interest rates go up by 1%, the value of the bond that you hold is going to fall by the duration. So if you owned a bond with a duration of 5 and interest rates go up by 1%, the value of your bond should fall by approximately 5%. Well, so let's just put this in context. You own a 5-year treasury, interest rates go up 4%. The theoretical math says the value of that bond should go down by 20%. I can guarantee you financial advisors who are putting their client capital in, securities with any form of duration didn't necessarily appreciate, because history hasn't shown them that it would be this drastic, that the value of their fixed income holdings were going to fall so dramatically. Yeah. So where do we stand? Okay, so we just walked through where we were. Pandemic interest rates were incredibly low. As a result of the inflation from the pandemic, we had this inflationary spike. As a result of that inflationary spike, the U.S. Fed has raised interest rates significantly. forcing the whole yield curve up dramatically. Okay, so where are we today? Let's look at another Bloomberg screen. So this is another Bloomberg chart, and it shows what is priced into the fixed income markets in terms of future interest rates, future Fed funds rate. So you can see we're right here, a little over 5%. And what this is telling you is kind of at the end of this year, Fed funds rate might go up a little, and then it's going to start falling. So what does this mean? So what this means is the vast majority of the interest rate raising the market believes is over. And another term for that is tightening, and that the Fed is going to have to start reducing interest rates kind of in late 2023, early 2024, really throughout 2024. And the market is anticipating that they're going to do that really in response to how the higher interest rates are impacting things like our GDP and our employment. Those are two kind of headline metrics that our Fed is really focused on. And as unemployment starts potentially being less strong, as our GDP, people are talking about us having a soft landing at this point. There's still significant debate about whether or not we're going to have a soft landing. But in your regard, the market is expecting that the Fed is going to have to reduce interest rates in order to stimulate the economy in 2024.
So, Dave, it's interesting. Whenever you're talking about interest rates moving up, if the duration is 5 and rates move up 4%, well, then we potentially see a 20% decrease in the valuation, somewhere in that decrease as far as the valuation of those fixed income holdings. I'm assuming the converse also holds true as far as for our listeners, that if we're holding a duration of 5 and interest rates decrease by 2%, then they should see relatively about a 10% increase as far as the value of their fixed income holdings. Does that hold true about the same way?
The math certainly holds true. But let's talk about the shape of the yield curve. I'm going to pull up what we call, I'm going to share my screen again. Let me share it this time. I'm going to pull up what we call the Treasury actives curve. So this is the shape when it comes up. Johnny, we talked about it before we started this podcast, but the term inverted yield curve.
Right. So
this is the shape of the yield curve today. And as you can see, from about the 6-month part of the curve through the 10-year part of the curve, it is inverted. So the math that you articulated is absolutely correct. I think the question is, if the Fed starts reducing interest rates, right, they have control of this part of the curve, the very front of it. If they start reducing interest rates, and the previous screen we looked at showed them, about 1%. So if they lowered it here, I think the question, I know I certainly have, I don't have a crystal ball on this. Is the 10-year, the 7-year, and the 5-year, are they also going to go down? Or is just the shape of the front end of the curve going to kind of come down and normalize the shape of the overall yield curve? But the math you articulated is absolutely correct. If interest rates come down, 1%, if this 10-year interest rate comes down 1%, and this has a duration, 10-year Treasury duration of 7, you're right. The value of that bond would go up by about 7%.
So part of the way that our listeners should look at that would be to look at their length of term and duration, and then look at the actual movement of that duration. So it's not to say if we have the ultra short term, that 1 monther going down by 3 percentage points, that we should look at that, compare that to the 10-year. It wouldn't hold true. You want to match up the duration with the actual movement of the duration to kind of give you that general back of the envelope calculation on that. It's when I kind of think about this, we hear a lot of people talking about, different tried and true philosophies on portfolio management. And some of that they start to question, and they read things online. And so one of the old rules of thumb is you want to diversify your assets. You want to have an allocation to your growth assets, an allocation to your fixed income assets, an allocation to your cash assets, and then you have real estate in there, and you have private equity, and you have other different types of assets in there. But as far as, let's just say, the equity versus fixed income discussion, an old rule of thumb, a lot of folks look at a 60%, 40% portfolio, and they kind of use as a benchmark. And there's a lot of discussion that the 60-40 portfolio is dead because they were correlated last year. The S&P was down over 19%, and the bond index was down over 16%. And so therefore, it's too correlated on diversification. If someone's having that thought, thought, how should they be thinking through fixed income as a portion of their overall allocation?
Yeah, such a great question. The way we think about asset allocation is one absolutely must know what the objective of that capital is, and marry the objective of that capital with the characteristics of that asset class that they're investing in. That is, to me, that is the most important thing we're talking about here. We are fixed income guys, and we are the first guys in the room to say, if you have long-term capital, you should not be in fixed income. Why? Because if one analyzes equity at a very high level, equities versus certain elements of fixed income versus certain elements of the cash market, you'll find that effectively equities always beat fixed income over the long term. Now, that's a big general statement. So, it's so critical that a financial advisor who really understands a client's specific situation can guide that client through kind of really understanding the objective they have with certain buckets of their capital and appropriately marrying that objective with the asset class that the investor is investing in. So, we do cash management and fixed income. Well, our cash management is fixed income. We're just investing capital in U.S. Treasuries. But when we invest that capital in a U.S. Treasury, we are not investing it in a U.S. Treasury that comes due in 30 years or even 10 years or even 5 years. Why? Because when somebody thinks about cash, they're thinking, I want to know that I'm taking no risk whatsoever with that money, number one. Number two, they want to know that they can get that money anytime they need it. It is 100% liquid. So when you think about that, like there are certain risks that you can't take when you allocate cash in the fixed income markets, and duration or interest rate risk is one of those. So we are actively investing people's cash in treasuries that mature between today and 6 months from today. And we can guarantee our clients safety of principal, liquidity, they can have it tomorrow or even today. They tell us by a certain time. And because we're allocating that money to U.S. Treasuries and we're watching the shape of the front end of that curve like a hawk, and we're actively managing it, that client knows that they're going to do better than any bank that's going to hold their money, any CD that's going to hold their money, and any money market fund that's going to hold their money. So that's cash. But we still will look at that client and say, in your cash bucket, you're still leaving money on the table, but that's okay, because what you're getting for leaving that money on the table is the assurance that you can have that money anytime you want without taking any loss of principal. But then in our unconstrained fixed income strategy, we are sure that over the medium to long term, we are going to significantly outperform those folks who are in our cash strategy, but there's going to be more volatility and drawdown associated with those portfolios just because we're taking more interest rate risk. We're taking more default risk. We're experts in managing those things, but because there's going to be volatility, if you will, on the market of that portfolio, we tell people you shouldn't deploy capital in this, unconstrained fixed income portfolio unless you have at least 2.5 years. So again, it's critical to match the objective of the capital with the characteristic of the asset class that it's being invested in. That is, I think, correct me if I'm wrong, because I think you spend more time thinking about wealth management than I do. But to me, that's a core principle in everything that's being done.
You communicate it so well, Dave. I mean, the principles that we have is that we set, make sure we know our core values, that we set goals based upon the core values. The goal has to have a time frame of when you're going to need the capital and what is the dollar amount of the capital you need in that time frame. And then we set our financial resources to realize the goals. Well, that's when you'd say we have a goal objective of X number of months, X number of years. Well, that's when we'd have a liquid managed account or a short-term account that is tied to that. But if our goal objective is longer, well, then you go into some maybe higher risk investments. But the closer you get, you start shifting more and more into the guaranteed liquid side. So, I mean, that was just brilliant the way you brought that down as far as the time frames and the way that the different management strategies make a lot of sense on the fixed income side and the cash side. So that's beautiful. We have covered a lot of stuff, David. Is there anything else in this first discussion? I know we're going to get a lot of comments. They're going to say, hey, can you bring David back on? So maybe under phase 2, we'll kind of go more detail. But anything else that we've not talked about that you think, man, is critical right now in this moment to get this concept or thought out to people?
Yeah, it's a great question. The most important thing is the thing we've talked about, matching, and we're fixed income guys. And we're fixed income guys who will tell our clients, this is long-term capital. You got 10 years. Don't worry that there's going to be a recession tomorrow. So one thing we haven't talked about that I think is so critical is the importance of not fooling yourself with your ability to forecast the future. The fact of the matter is, if you go read any study about the accuracy of expert forecasts, you find that you might as well have just thrown a dart at a dartboard. Truth is, none of us know what the future holds. We don't. Now, I think we all hold certain things to be absolutely, effectively 100% events. Like, is the United States going to continue to exist? I'm a patriot. I absolutely believe that. But so if assuming the United States continues to exist, it's critical that you don't throw the baby out with the bathwater when you acknowledge that you do not have the ability to forecast the future. Within that framework of I don't know what the future holds, because the markets are effectively a pari-mutuel betting system, which means that it is accurately pricing risk and reward. There are certain things we do know. What are those things? Over the long term, I'm going to start at the top of the food chain. Over the long term, venture capital will outperform private equity. Why? Because all things being equal, venture capital is taking more risk than private equity because it's smaller companies. Ideas don't have necessarily revenue associated with it. So if you're going to take more risk, over the long term, you need to be more highly compensated. Now, private equity is going to outperform public equity over the long term. Again, why? Well, again, a very broad brush stroke. Private equity, assume it's the exact same thing as public equity, but no liquidity or less liquidity. Okay, so you need to get compensated more for that. Public equity is going to outperform bonds because bonds, let's just use corporate bonds as the example here, are lower in the capital structure than the equity is. A corporate bond is, on average, they're going to outperform U.S. Treasuries. So there's this cheap principle. Now, so while you might do better, the higher part of that capital stack, venture capital, private equity, public equity, there's going to be a lot more volatility. You might, like public equity, S&P 500 experienced a 56% drawdown in 2009. But don't let that dissuade you. Don't let the pundits who are saying, we have a recession around the corner. The fact of the matter is, people thought it was going to be a hard landing 9 months ago. Today, they're wondering whether it's going to be a soft landing or no recession at all. The fact of the matter is, we just don't know. But we do know equities will outperform. So slowly use principles like dollar cost averaging and slowly leg in with your longer term buckets of capital into the things that will absolutely outperform over the long term. And then on the shorter duration stuff, that's where guys like us come in to make sure we significantly outperform the markets. So that was a lot longer kind of final thought than you wanted, but that's what I'll come in.
I'll tell you what, Dave, that's a great summary as far as on expectations people should have based upon their time frames and their risks that they need to take, and to align that with their goal objectives. And David, I want to thank you so much for spending time with us today, and it's kind of walking through some things with helping people make better decisions in areas critical for them. Well, that's their risk management on the cash side, on their fixed income side, and phenomenal resource. Everybody, see the notes section of the podcast, you'll be able to find contact information for David. RooseveltCapitalManagement.com will be linked in there. I would point your direction a couple of things on their site, the strategies tab, and also the commentary and news. I learned a tremendous amount myself, actually, in commentary and news. I direct you to both of those, and contact information also if you want to reach out to David, or you can always contact us here at Creekmur Wealth, and we'll get you in contact with David the best way possible. Again, everybody, thank you for listening to Great Decisions, Incredible Lives. Retire and live with intention, and look forward to catching you again next time whenever we drop the next podcast. Talk to you all later.
Thank you again for listening to the Great Decisions, Incredible Lives, Retire with Intention podcast with host John Creekmur. Follow us on social media, visit our website, and join our community of like-minded individuals redefining retirement and living incredible lives. Please please leave us a review and share our podcast with others who may benefit. We wish you a future filled with purpose, fulfillment, and the joy of living your incredible life in retirement.